Imagine your sixth-grade son comes home and tells you he's starting a business. He's selling gum. He bought gum packs for 25 cents and is selling the individual sticks for 25 cents each, making a 400% profit. You'd be impressed, right? Now, what if he told you he could buy his friend's entire identical gum business for half of what it's worth? You'd tell him to jump on it. That simple, powerful idea is the core of Joel Greenblatt's legendary investing strategy. This is the magic formula from the little book that still beats the market. It's a surprisingly simple, systematic approach to investing that has historically crushed the market averages. The strategy boils down to just two key ideas. First, find good companies. And second, buy them at cheap prices. That's it. But the genius is in how Greenblatt defines good and cheap. So how do you find a good company? Greenblatt isn't looking for trendy brands or flashy products. He uses one simple metric, a high return on capital. Think back to that gum business. A high return on capital means the business is incredibly efficient at turning money into more money. It's like having a machine that costs $1,000 to build but spits out $500 in profit every year. Another machine might cost the same but only spit out $100. You obviously want the first machine. Greenblatt's formula systematically scours the market for companies that are the most efficient profit machines. But even a great profit machine is a bad investment if you overpay for it. This brings us to the second part of the formula, finding cheap companies. Greenblatt uses a metric called earnings yield. Don't let the jargon scare you. It's just a smart way of looking at a company's price tag. It compares the company's operating profit to the total price you'd have to pay to buy the entire company, including its debt. A high earnings yield means you're getting a lot of earning power for the price you pay. It's the investing equivalent of finding that amazing profit machine in the clearance aisle marked down 50%. So the magic formula ranks all the stocks based on these two factors, goodness and cheapness, and tells you which ones to buy. It sounds too simple to work, but backtesting showed it delivered astounding returns. So why isn't everyone doing it? Here's the most surprising insight. The formula doesn't work all the time. There will be months and even a year or two where it underperforms the market. And this is where most people fail. They lose faith, get impatient, and abandon the strategy right before it's about to pay off. The real magic isn't just the formula itself. It's having the discipline and psychological fortitude to stick with it through the tough times. That's the barrier to entry that allows the strategy to keep working for those who are patient. To recap, the wisdom from the little book that still beats the market is to invest systematically, not emotionally. Focus on buying good businesses, those with a high return on capital at bargain prices, identified by a high earnings yield. Then, the hardest part, be patient. A key takeaway is to remember that the stock market is a tool to buy pieces of real businesses, not just flashing ticker symbols. Focus on the value of the business, and the stock price will eventually follow. If you enjoyed this approach, you might also like Benjamin Graham's classic, The Intelligent Investor, or Peter Lynch's One Up on Wall Street. Find more great summaries and reading guides at booksplat.com. Level up yourself today, 3 minutes at a time.